A week ago, the market priced the war as a fading risk. This week it inverted. The United States and Iran are trading strikes for a second straight day. Iran has declared the Strait of Hormuz closed, and Brent crude is above $93 a barrel, up more than a quarter since the war began. That single strait now sets the price of oil and the inflation print that runs off it. And that shock just did something it hasn't done in 3 years. It forced a major central bank to raise rates. The European Central Bank hiked into a slowing economy, cutting its growth forecast and lifting its inflation forecast in the same breath. Stagflation, formalized. The Federal Reserve sits in the identical box, one meeting before its new chair's debut. So where's the edge? Not in the crowd chasing the largest public offering in history into a thin tape. It's in the domestic energy the shock pays instead of punishes, onshore, lowest cost, insulated from the strait, and bid by the artificial intelligence power build. The collector, not the crowd. This is the asymmetric. This is the asymmetric, issue 13, the Chokepoint, tech and crypto investing for thoughtful retail from an operator's lens. The risk the market had retired came back as the regime's master variable, and the edge moved to the one asset the energy shock pays instead of punishes. Here's the one-line read. The war re-escalated into a second day of strikes. Iran declared the Strait of Hormuz closed, and Brent crude pushed above $93, turning the energy line that drove 4.2% inflation into a widening shock, not a fading one. That same shock forced the European Central Bank to raise rates a quarter point to 2.25%, its first hike since 2023, cutting growth while raising inflation. Equities sold hard. Oracle's record backlog could not save it from a 10% drop on a capital spending blowout and a $40 billion raise, and the largest public offering in history prices tonight. Underneath the noise, the durable read is who the energy shock pays, and the lowest cost domestic gas producer is insulated from the strait and bid by the artificial intelligence power build. The same discipline labels run throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. This is research, not advice. Part 1, the Chokepoint, 1 straight, and 2 boxed-in central banks. The regime at a glance. Brent crude above $93, up a quarter since the war began, with the Strait of Hormuz declared closed. Headline inflation at 4.2%, the hottest since 2023. The European Central Bank's deposit rate up to 2.25%, its first hike since 2023. Gold firm near 4,080. Bitcoin rebounding near 63,000, working a bottoming process. And the new Federal Reserve Chair's first meeting, June 16th and 17th, boxed in. He cannot ease into a 4.2% print. The energy shock is no longer a single print. It is a two-continent policy event. Start with rates. A hot print the Federal Reserve cannot ease against. Headline inflation ran 4.2% year-on-year, the hottest since 2023, a third straight monthly acceleration, with the energy line the dominant driver as the Iran premium landed in the data. And that driver is now widening, not fading, with the war back in escalation. The market prices the next move as a hike, not a cut. And it hands the new chair a 4.2% headline 1 week before his first meeting. The deeper bind the macro desks keep returning to, with deficits rising into a war, a central bank that defends the currency sacrifices the bond market, and the reverse. The European Central Bank's hike is the first hand forced. That is the confirmation signal. The European Central Bank raised its deposit rate a quarter point to 2.25%, its first hike since 2023, made explicitly to counter inflation from the Middle East conflict. Euro area inflation had accelerated to 3.2%, and in the same decision, the bank cut its growth forecast to under 1% while raising its inflation forecast above target. That is stagflation, made into policy. A second major central bank has now been forced to tighten into a war-driven supply shock, which validates the read that this energy shock is a structural, cross-border inflation force, not a one-print event in the United States. Then the structure of the market, a hard sell-off, and the artificial intelligence capital spending bill coming due in cash. The S&P 500 fell more than 1.5%, the Dow nearly 1,000 points, with volatility spiking on the war and inflation combination. And Oracle became the cautionary tale, record revenue and a stunning backlog of orders, but its capital spending blew through its own guidance. With a $70 billion plan for next year and a fresh $40 billion capital raised to fund it, the stock fell as much as 10% after hours. The market's verdict: backlog is not cash, and a build-out that has to raise money to grow gets marked against a high discount rate. Into that tape lands the largest public offering in history. SpaceX prices tonight and trades Friday, about $75 billion raised at a fixed price, at a valuation near $1.75 trillion, more than triple the previous American record. The book is heavily oversubscribed, with more than $250 billion of demand. The mechanism is what matters. A primary deal of this scale pulls cash out of the secondary market, a mechanical liquidity drain on the same narrow set of megacaps and on crypto, at the exact moment the tape is thinnest. A strong debut says the appetite is still there. A weak one says the demand limit is found. Now the havens under the war bid. Gold held firm near $4,080, up on the day, structurally elevated on the safe haven and war bid, a 4.2% headline, a reclosed Strait, and two central banks raising into stagflation is exactly the regime gold is built for. Bitcoin steadied near 63,000, rebounding from a lower open after a rough month. Independent desks describe a bottoming process at long-term support, while cautioning the selling may not be over. The two havens split, gold trading as the macro hedge the regime rewards, Bitcoin as a high beta liquidity proxy being used to fund the offering chase. Put it together, the regime found its master variable. One Strait now sets the oil price, the inflation line, and the hands of two central banks, the European Central Bank hiking into stagflation, the Federal Reserve boxed before its new chair's debut, while the largest offering ever drains a thin, derating tape, and Oracle's print marks the capital spending bill against the discount rate. The shock has a payer and a collector. So where is the asymmetry that gets paid by it? Optionality, less duration, less leverage, plus the domestic energy layer the shock pays instead of punishes. Part 2 in focus, the energy the shock pays, the data, then the debate. The lead is EQT Corporation, the war hedge that also collects the artificial intelligence power bill. Our workup pulled its numbers live from its regulatory filings. In the first quarter, EQT earned $1.5 billion in net income on $3.4 billion in revenue, with $3 billion of operating cash flow in a single quarter. That alone is about 3/4 of all of last year's earnings. The signature of a low-cost producer's leverage to a higher gas price. And the balance sheet is the standout. Long-term debt cut to $5.5 billion from over $7 billion a year earlier, deleveraging at speed. The bull case: it is the largest, lowest-cost American gas producer, onshore, insulated from the Strait, and bid by a structural demand story, as data centers are projected to pull billions of cubic feet of gas a day by 2030. The bear case: it is a commodity producer and a price taker. The quarter rode a higher gas price that can reverse, and the power demand thesis is multi-year. The structural case is high confidence. The entry is the hard part, because the cyclical gas price can hand you a better one. In crypto, the read is that Bitcoin is trading as a liquidity asset, not a haven. It steadied near 63,000, working a bottoming structure at long-term support, but the next support, if that breaks, is 50 to 53,000. It is being sold for the offering chase, pressured by the war and inflation tape, and unsupported by a market structure bill that has stalled in committee with no floor date. This is a watch the support, do not chase, setup, not a thesis break. A reclaim of the mid-60s with flows turning says the low is in. A loss of long-term support says the unwind has another leg. And the thematic read: the energy shock sorts the market into who pays and who collects. It pays the domestic energy complex, low-cost gas, power, electrical equipment, and the hard asset hedge, gold. It punishes the importers exposed to the Strait, the duration-sensitive growth names, and the build-outs that have to raise capital to fund their spending. Oracle's $40 billion raise into a 10% drop is the cleanest example. The artificial intelligence build sits on both sides. It is the demand engine for the power the collectors sell, and the capital sink whose issuance drains the tape. The cleanest positive asymmetry is the layer that gets paid by everyone else's shock and is insulated from the choke point. Part 3. The choke point signal. The war is no longer a tale, it is the regime. 2 central banks are boxed, and the European Central Bank just proved it. The capital spending bill is paid in cash now, and the market is checking ORCL's backlog could not save it. And the collector is domestic energy the shock pays, EQT, onshore lowest cost, deleveraging, double bid by the war premium and the power build. Where the edge stays, optionality plus the collector. What we are watching the next 10 days. SpaceX prices tonight and trades Friday. The Strait of Hormuz, a sustained closure versus a strikes completed turn, and any move on Carg Island. The Federal Reserve and its new chair's first meeting, boxed in by a 4.2% headline. Whether the European Central Bank's hike starts a cycle. ORCL's aftermath, whether the raise re-rates the debt-funded cohort. A copper review at month-end. Natural gas prices against the data center demand that underpins EQT, and whether Bitcoin holds its long-term support. And we keep score in public. EQT, the lead positive asymmetry name, the energy the shock pays. Freeport McMoran, the copper bottleneck bellwether. ORCL, avoid the capital-raising build-out. Gold, constructive on the war and reserve bid. Bitcoin, a macro-driven bottoming process, entry-sensitive. Alphabet and Broadcom, quality, patient on entry. And Robinhood, a new watch, as a beneficiary of the offering wave. Each is a dated, falsifiable call. And we grade them. So where does it land? 3 takeaways. 1. Strait now sets the regime, the war re-escalated, the Strait of Hormuz closed, and the energy shock forced the European Central Bank to hike and box the Federal Reserve. The edge moved to the energy the shock pays, EQT, transformed, the lowest-cost domestic gas producer, insulated from the Strait and double bid. And the liquidity drain prices tonight, while the capital spending bill came due, backlog is not cash. And supply is a mechanical drain. The edge is optionality plus the collector. That's the choke point. The asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. The Strait closed. The collector did not. We'll see you in the next issue.